Welcome to the Deep Dive.
Thanks for having me.
Today we're diving into commercial real estate financing in 2025.
Yeah.
It's a pretty hot topic, especially if you are following commercial real estate.
Yeah, definitely a lot happening.
So to guide us on this deep dive, we're using an article by Michael Linton.
Oh, he's a great resource.
He is.
Yeah.
He's a commercial broker, been in the Chicago market over 38 years. Wow.
That's a long time.
You can find his work on his website, chicagodealflow.com.
Lots of good stuff there.
Yeah. In this deep dive, we're going to, break down the lending landscape as it stands today.
Right?
And we'll explore the different ways you can finance a commercial property,
Sure.
what lenders are even looking for these days, which seems to change all the time.
Yeah, it does.
And then we'll discuss some strategic moves to get you the best outcome.
Sounds good.
So if you're involved in commercial real estate, whether you're, an investor or a developer, you've probably got financing on your mind.
Oh, absolutely. It's crucial.
Especially with everything that's been happening in the economy.
Yeah.
And as Michael Linton writes in his article, there's a lot of commercial mortgages maturing this year.
That's right. Big wave of them.
So, being well-informed can make a world of difference.
It really can.
Yeah, and that's what we're aiming to do. We want to give you a clear understanding of the key trends and strategies that Michael Linton discusses.
That's the goal.
In a way that's, practical, easy to grasp,
Right.
so you can confidently navigate this landscape without, getting lost in all the financial jargon.
Right. No one wants that.
Nobody wants that. Let's get straight to the point.
Let's do it.
Michael Linton uses this term, debt wall. Have you heard this term before?
I have, yeah.
Okay, so he's talking about this huge amount, $957 billion
Huge number.
in commercial mortgages that are coming due this year.
That's right, yeah.
2025.
Yeah.
What should someone listening, what should they think when they hear a number like that?
Well, it's definitely a little intimidating.
It is a little intimidating.
But as Michael Linton points out, it kind of creates this interesting dynamic. On one hand, you've got all these property owners who need to refinance these loans, so there's pressure there. But then on the flip side, if your properties are doing well, you've got good fundamentals, it could actually work in your favor.
Oh, interesting.
Lenders are going to want your business, so you might be able to negotiate better terms, lower rates, things like that.
Okay, so it's a double-edged sword.
It really is.
It's both a challenge and an opportunity.
Exactly.
Now, something else Michael Linton talks about in his article on chicagodealflow.com, he mentions what happened with interest rates in 2024.
Right, kind of unusual year.
Kind of, a bit of a head-scratcher because short-term rates, they actually dropped.
Yeah, surprisingly.
But long-term rates went up. So how does that affect how we think about refinancing?
That's a great question. If you were hoping for those lower short-term rates to make refinancing cheaper,
Right.
the rise in long-term rates might have thrown a wrench in your plans.
Oh, okay.
Locking in financing for the long haul might cost more than you initially thought.
So it really underscores the importance of being informed, like we were saying.
Absolutely. Michael Linton's really spot on about that.
Yeah, but it's not all doom and gloom.
Yeah,
No?
yeah, definitely not.
Michael Linton also mentions a projection from the Mortgage Bankers Association.
Right.
That lending volume is expected to jump quite a bit in 2025.
Yeah, by a good amount.
It's like a 16% increase, bringing it to a possible $583 billion.
Right.
What do you make of that?
I think that's a really positive sign.
Okay.
Even with all this talk about the debt wall and interest rate uncertainty, there's still money out there for commercial real estate.
Just not drying up.
Not at all.
Yeah.
It means if you've got a solid deal,
Right.
good fundamentals, chances are you'll find financing.
Okay, that's good to know. Now, let's step back a little bit.
Sure.
For folks who might be more familiar with, getting a mortgage for their home, how are commercial real estate loans different?
Yeah, that's a big question.
Big question.
And Michael Linton does a nice job of explaining this. Basically, commercial loans, they're specifically for properties that are used for business.
Oh.
So think office buildings, retail spaces, industrial warehouses, apartment buildings, things like that.
Okay, got it.
And one of the first things you'll notice is the loan terms are different. They're usually shorter than residential mortgages, maybe 5 to 10 years. But the amortization schedule, which is how long you have to repay, that's usually longer, like 20 to 30 years. And that often means there's a balloon payment at the end.
A balloon payment. So
Yeah.
you're not paying off the entire loan over those 5 to 10 years.
Right, exactly.
I have-
At the end of that term, you'll owe a big chunk of the principal, the balloon payment.
So you've got to have a plan for that, like refinancing or selling the property.
Exactly. As Michael Linton would say, you got to plan ahead.
Okay, what else is different about these loans?
Well, the underwriting process is a lot different, too. With a home loan, they look at your personal finances, your credit score.
Yeah.
But with commercial loans, the focus is really on the property itself.
Ah, okay.
Can that property generate enough income to cover the loan payments and the operating expenses?
Makes sense. They're not so worried about you, they're worried about the building.
Right, the building's got to stand on its own.
Okay. Anything else that's different?
Yeah, Michael Linton also points out that non-recourse loans are more common with commercial real estate.
Non-recourse.
So basically, if you default, the lender can only go after the property, not your other assets.
Oh, that's interesting.
It gives you some protection, but they usually have stricter conditions.
Got it. So it's not a free pass.
No, not at all. And you should also know that down payments are generally larger with commercial loans, maybe 20% to 35%, and the fees and closing costs are usually higher.
All right, so shorter terms focus on property income, possibility of non-recourse, bigger down payments, and higher upfront costs.
That sums it up pretty well.
Okay, good overview. Now, Michael Linton's article also walks us through all the different types of commercial loans out there.
Yeah, there's a whole menu of options.
There really are. Let's break them down one by one, starting with what Michael Linton calls the most basic,
Yeah,
traditional bank loans.
right.
What are the pros and cons there?
Well, bank loans can be good because they might have the best interest rates, competitive rates. Michael Linton says we're probably looking at a range of 6.5% to 8.5% this year.
Okay.
But banks are also pretty careful. They're going to want to see a strong credit history, and they really like properties that are already stable, producing consistent income.
So if your property's a little riskier,
Yeah.
a bank loan might be tough to get.
It could be, yeah. The terms are usually in that 5 to 10-year range we talked about, with amortization maybe up to 25 years.
Hmm.
And their loan-to-value ratios are usually capped at around 65% to 75%.
All right, makes sense. Then there are SBA loans.
Right, those are backed by the Small Business Administration.
So what are the benefits of going the SBA route?
Well, Michael Linton points out that SBA loans can sometimes have lower down payments, maybe even as low as 10%. And they offer longer terms, too, potentially up to 25 years. But there's a catch. You have to actually occupy most of the space yourself.
Oh, so it's not just for any commercial property.
Right, it's primarily for owner-occupied properties.
Yeah.
Like your business needs to be operating out of at least 51% of the space.
Okay, interesting. And what about the different SBA programs?
Well, the two main ones are the 7A loan, which is pretty flexible and can go up to $5 million, and the 504 loan, which is specifically for buying major assets, like the real estate itself.
So if you're buying a building for your business,
Yeah.
the 504 loan might be a good option.
It could be, yeah.
Okay, moving on, we've got CMBS loans, or conduit loans, as they're sometimes called.
Right, those are a bit different.
They are. How so?
So CMBS loans, they're actually bundled together with a bunch of other commercial mortgages and then sold off as bonds to investors.
Okay, so it's not a bank directly lending you the money.
Exactly. One advantage of CMBS loans is that they're often non-recourse.
Okay, that's good for the borrower.
It is. And they usually come with fixed interest rates, typically for terms of 5 to 10 years. Amortization is longer, usually 25 to 30 years.
All right, but they have prepayment penalties, right?
Yeah, that's one thing to watch out for.
You can't just pay the loan off early without paying extra.
Right. And they often have stricter requirements, too, like having reserves for things like taxes, insurance, unexpected repairs.
So you got to have cash on hand for those things.
Exactly.
All right, next up, Michael Linton talks about debt fund loans.
Those are interesting.
Tell me about them.
So debt funds, they're basically private investment groups that lend money directly to commercial real estate projects.
So they're not your typical bank.
No, they're not.
Yeah.
And they're a bit more flexible in their underwriting.
So if you've got a more complex project,
Yeah.
or maybe a property that's in transition,
Exactly.
this might be a good option.
Could be, yeah.
But they come with higher interest rates, right?
They do, usually a couple of percentage points higher than what you get from a bank. And the terms are generally shorter, like 2 to 5 years.
All right, so flexibility comes at a cost.
That's right.
Makes sense. Now, Michael Linton also mentions hard money loans.
Right, those are a whole other animal.
In what way?
Hard money loans are super short term, meant to be a temporary fix.
Okay,
And they're really based on the value of the property, not so much your credit score.
interesting.
And they close quickly, like within weeks, with less paperwork. But the interest rates are sky high, sometimes 10% to 15%.
Oh, wow, that's steep.
It is.
So when would you even consider a hard money loan?
Well, Michael Linton suggests them for, like, really time-sensitive deals or for properties that need a ton of work before they can qualify for traditional financing.
Okay, so it's like emergency money almost.
Yeah, sort of. Like, imagine you find a distressed property that's a steal, but it needs major repairs.
Right.
A hard money loan could help you get it fast and then fix it up.
Okay, got it. And then finally we have bridge loans.
Right.
What do those bridge?
Well, they're short-term, usually 6 months to 3 years, and they're designed to cover a temporary financing gap.
Okay, like what kind of gap?
Well, it could be the time between buying a property and securing permanent financing, or maybe while you're renovating a property to increase its value.
So it helps you get to that long-term financing.
Exactly.
All right, that makes sense. So we've covered the different types of loans, and that's great. But how do you actually qualify for one of these loans?
Yeah, that's the key question.
It is. Michael Linton mentions credit score, LTV, and DSCR as important factors.
Those are the big three, yeah.
So let's break this down.
Right.
First, credit score.
Yeah. Lenders want to see that you can handle debt responsibly.
Makes sense.
For conventional loans, they usually like to see a score above 680. SBA loans might be a little more lenient, maybe 650 or so.
Okay.
And some debt funds or hard money lenders might go even lower, but you'll pay for it with higher rates and fees.
So good credit is always an advantage.
It definitely helps.
All right, next up we've got LTV, loan to value.
Right, that's how much of the property's value you're borrowing.
Okay.
So for example, if you're buying a building for $1 million and the loan is for $750,000, your LTV is 75%.
Got it. And what are the typical LTV limits?
Well, it depends on the loan type, as Michael Linton points out. For conventional loans and CMBS loans, it's usually 65% to 75%. SBA loans can go higher, maybe even up to 90% in some cases.
Wow, that's significant.
It is. And then debt funds might go even higher than that, maybe 75% to 85%. But hard money lenders tend to be more conservative, usually topping out at around 60 to 70%.
So the riskier the loan,
Yeah.
the lower the LTV.
Makes sense.
Makes sense. Okay, and then we have DSCR, debt service coverage ratio.
Right. That's all about the property's cash flow.
Okay, how so?
It basically tells lenders if the property can generate enough income to cover the loan payments.
And what's a good DSCR?
Well, most lenders want to see a DSCR of at least 1.25, but it can go up to 1.5 or even higher, depending on the property and the lender.
So a higher DSCR means the property is in better shape financially.
Exactly. It's less risky for the lender.
Okay, that makes sense. Now, Michael Linton also mentioned minimum loan amounts in his article.
Yeah, those can vary quite a bit.
Give me a sense of what we're talking about.
Well, for big national banks, you might be looking at minimums of $1 to $5 million.
Okay.
Regional banks might be a little lower, maybe $500,000 to $1 million. Local banks and credit unions might go even lower. And for SBA loans, there's not really a set minimum, but practically speaking, it's usually at least $350,000.
Okay.
And CMBS loans and debt fund loans, those usually start at $1 to $2 million or more.
So if you're looking for a smaller loan,
Yeah.
you might have to shop around a bit.
You might, yeah.
Okay, got it. So we've talked about credit score, LTV, DSCR, minimum loan amounts.
Right.
What about collateral?
Yeah, that's important too.
What kind of collateral do lenders typically want?
Well, first and foremost, it's going to be the property itself.
Okay.
They'll want a first position lease on that. They'll also usually want an assignment of leases and rents.
So they can collect rent directly from tenants if they need to?
Exactly. And if it's a recourse loan, meaning you're personally liable,
Right.
they'll probably want a personal guarantee from you or other key people involved in the loan.
So you're on the hook if things go south.
You are, yeah.
Hmm.
And in some cases, they might even want additional assets as collateral.
So you got to have skin in the game.
Yeah, that's right.
Okay, that makes sense. Now, let's say you've figured out what kind of loan you need, you understand the qualifications, but how can you actually improve your chances of getting approved and maybe even negotiate better terms?
That's where strategy comes in.
Exactly. Michael Linton offers some great advice on this in his article.
He does.
He starts by emphasizing the importance of a solid business plan.
It's crucial. Yeah.
What makes a business plan so important in this context?
Well, it's your chance to show lenders that you've really thought things through.
Okay.
They want to see that you understand the property, the market, your financials, and your exit strategy.
So it's not just a formality?
No, not at all.
Yeah.
A good business plan shows them you're serious and you're a savvy borrower.
Got it. So it builds credibility.
Absolutely.
Okay, beyond the business plan, What else can someone do to strengthen their application?
Well, Michael Linton also recommends highlighting relevant experience.
So if you've successfully managed similar properties before,
Yeah.
make sure the lender knows that.
Exactly. And it's also good to show that you have strong cash reserves, not just for the down payment, but for unexpected expenses.
So you're financially stable.
Right.
Okay. What about exit strategies?
Having a few different exit strategies is important.
Ah.
It shows lenders you've thought about what you'll do down the road, whether that's refinancing, selling the property, or something else.
So you're not putting all your eggs in one basket.
Exactly.
Makes sense. Anything else?
Yeah, Michael Linton also recommends providing third-party reports, like independent appraisals or market studies.
So you're backing up your claims with data.
Right.
And what about tenants?
Oh, tenants are huge.
Yeah.
If you've got strong tenants in place with good credit and long-term leases,
Right.
that's a big plus for lenders.
Because it means steady income for the property.
Exactly.
Okay, that all makes sense. Now, let's fast forward a bit. You've submitted your applications, and you've got a few loan offers on the table.
Nice.
Now it's time to negotiate, right?
That's right.
How can someone effectively negotiate for better terms?
Michael Linton has some great tips for this.
Yeah.
First off, use those multiple offers to your advantage.
So play them off each other a little bit?
Exactly. Lenders like competition, so let them know you have options.
Okay, that makes sense. What else?
Well, emphasize the value of a long-term relationship.
So if you might borrow from them again in the future,
Yeah,
let them know.
exactly. And be specific about what you want.
So don't just say, I want a better rate.
Right. Say, I'd like the interest rate lowered by 0.5%, or I want to reduce the origination fee.
Okay, be precise.
Right. And it helps to have data to back up your requests.
So show them what other lenders are offering.
Exactly.
Makes sense. Any other tips?
Yeah. Be willing to compromise. Maybe you're willing to pay a slightly higher fee for a lower rate, or vice versa.
So it's a give and take.
It is.
All right, that's helpful. Now, Michael Linton also talks about navigating the current interest rate environment strategically.
Yeah, it's tricky right now.
It is. So what does he suggest?
Well, if you think your property's income is going to go up in the near future,
Okay.
a floating rate loan with a cap might be a good option.
So you can benefit if rates drop further.
Exactly. But you're also protected if they go up too much.
Okay, smart.
And if you've got a specific acquisition or refinance planned, you might want to look into a forward rate lock.
So you lock in today's rates for a closing later on.
Right. It takes some of the uncertainty out of the equation.
Makes sense. And for folks with a portfolio of properties, what does Michael Linton suggest?
He recommends staggering your loan maturities.
So they don't all come due at the same time.
Right. It spreads out your risk.
Smart move. And if you're planning to hold a property for the long term, are there any strategies for that?
You might consider paying points up front to get a lower interest rate over the life of the loan.
Okay, so it's a trade-off.
It is.
Higher upfront cost, but lower payments over time.
Exactly.
Now, we can't forget about refinancing.
Right. Huge topic right now.
Michael Linton highlighted this debt wall of maturing mortgages.
Yeah, lots of people need to refinance.
What strategies does he suggest for those facing a refinance?
Well, first and foremost, start early.
Don't wait till the last minute.
Exactly. If your property's value has gone up, you might be able to get supplemental financing.
Okay, so you tap into some of that equity without refinancing the whole loan.
Right. And if the value's gone down, you might need to do a cash-in refinance, which means bringing in more equity.
Okay, to improve your LTV?
Exactly. You can also try negotiating a loan modification with your current lender.
So they might adjust the terms of your existing loan.
Right. And if you're buying a property with an existing loan, see if you can assume it.
Okay, so you take over the seller's loan.
Right. Sometimes that's a good option.
All right, good to know. Now, Michael Linton also talks about the bigger picture, how the economy and things like the Federal Reserve's policy are affecting commercial real estate lending.
Yeah, those are major factors.
What's the current situation?
Well, interest rates are high right now, and there's more scrutiny from regulators, so lenders are being more cautious.
Okay.
And some regional banks have had problems, which has opened the door for more non-bank lenders, like debt funds.
So the lending landscape is evolving?
Definitely.
And what about regional differences?
Oh, those are huge. Lending terms can be very different depending on where the property is located.
So a property in a hot market might get a better deal than one in a slower market.
Absolutely.
Okay, that makes sense. And speaking of location, Michael Linton obviously knows a lot about the Chicago market.
He does.
What are some of the key insights he shares about Chicago specifically?
Well, he says that industrial and multifamily properties are doing well in Chicago,
Okay.
but office properties are facing more challenges.
So it's a mixed bag.
It is?
Interesting. Anything else about Chicago?
Yeah, he says the suburbs are seeing a lot of interest from lenders
Okay.
and that there are still good opportunities for value-add strategies.
So there's potential in the Chicago market.
Definitely.
All right, great. Now, last but not least, Michael Linton stresses the importance of understanding key financial metrics when evaluating loans.
Absolutely, you got to know the numbers.
What are some of the most important metrics he highlights?
Well, there's debt yield, which shows how much income the property generates relative to the loan amount.
Okay.
Then there's cash-on-cash return, which tells you how much cash flow you're getting back on your investment each year. And there's internal rate of return, or IRR, which gives you a more complete picture of your overall return over the entire investment period.
Okay, so IRR takes into account the time value of money.
Exactly.
And what about equity multiple?
That compares how much cash you'll get back over the life of the investment to your initial investment.
So it's a measure of how much your money grows.
Right.
And finally, there's break-even ratio.
That shows you the occupancy level or revenue you need to cover all your expenses and debt payments.
So it's like the point where you start making a profit.
Exactly.
Or that's a lot of metrics, but it sounds like they're all important.
They are. You need to understand them to make informed decisions about financing.
Makes sense. So as we wrap up this deep dive into commercial real estate financing in 2025, what are the key takeaways you'd like our listeners to remember?
Well, I think the biggest takeaway is that planning ahead is crucial, especially with all these mortgages coming due.
Right. Don't wait till the last minute to figure out your financing.
Exactly. And take the time to really understand the different types of loans out there.
And what each one entails.
Right. And then when you're ready to apply, be strategic.
Use all the tips Michael Linton shared.
Exactly.
Okay, great advice. So for our listeners out there, as you're thinking about your next moves in commercial real estate, remember that understanding financing is a powerful tool.
It really is.
Consider which aspects of this deep dive resonated with you and how you can apply those insights to your specific situation.
Yeah, good advice.
And if you want to learn more, where should you go?
Head over to chicagodealflow.com.
Michael Linton's website.
Yeah, he and his team have a ton of great resources there.
Excellent. Thanks for joining us on the deep dive.
It's been a pleasure.
We'll see you next time.
Sounds good.